Here with his firm's mid-year economic and market outlook for the remainder of 2013 is Scott Wren, Senior Equity Strategist at Wells Fargo Advisors. Scott, thanks for joining us.
Thanks, Ruben.
What's ahead for the U.S. economy in the second half of the year?
Well, I think the economy itself is going to continue to grow at a modest pace. I think you're looking at GDP this year of about 2.5%, a little bit better than last year. Low inflation, and I think that is a positive, certainly a positive for the stock market. I think you're going to see confidence improve on the business, consumer, and investor levels. So that should help, and I think that really the stock market has potential to, I think we've seen the bulk of the gains that we're going to see this year, but I think the market's going to finish a little bit higher this year. Maybe the S&P 500 would close the year in the 1650 to 1700 range. That's our target for the year end. But then really looking ahead to the end of 2014, I think the market has a good chance to trade higher in 2014, and we have a preliminary target out there of 1850 to 1900. So that's a good move from this current levels.
And so currently you're recommending that people kind of buy on these pullbacks that we've seen. Is that what people should be doing as we head into the second half of the year? Are we going to continue to see a little bit of this kind of seesawing, the market's going up and down, and maybe people should be taking advantage of those pullbacks?
You know, I think so. Really, it was a one-way street from November until the middle of April, or even a little bit later than that. And I think this volatility, you have to look at volatility as an opportunity right now. You know, in 2012, we had a couple of really good pullbacks, but retail investors, they were afraid of the market. They really weren't watching it, and so they really didn't take advantage of those opportunities. Now we're higher, and we certainly are pounding the table once again, telling our clients that, in our opinion anyway, you need to take advantage of these pullbacks. You need to be looking at these more cyclical sectors that are going to benefit from a continuation of the recovery here in the States, and then some better news that's going to probably come overseas over the course of the next 6 to 12 months.
That continuation of this recovery that you mentioned is something that the Fed obviously is looking closely at. The big question, of course, will they or won't they? When will they trim this $85 billion bond buying program? How long will it be before they do that? And so how should investors position themselves in the meantime?
Well, I think, once again, the uncertainty, that's an opportunity. In my opinion, as far as tapering, would not surprise me at all if the Fed didn't do anything until 2014. So I'm not looking for anything to happen this year. I think it's going to be a 2014 story. If you look at the parameters, the criteria that the Fed set really only a handful of months ago, 6.5% unemployment or 2.5% inflation, we are far, far away from either of those two things. I think we will be for a while. This GDP number in the second quarter is not going to be very good, 1.5%, 2%, maybe something like that. And so I think the Fed's going to keep the foot to the accelerator at least into 2014. And then, of course, to unwind this, it's a multi-year process.
And so what do we see? I mean, you know, here in the U.S., if we see, you know, the markets continue to perform well, consumer confidence, business confidence continue to improve in the second half of the year, what are we likely to see overseas? What will we see in Europe and what will we see in Asia? Will we see kind of a lag effect of them kind of starting to, you know, the markets there starting to improve as well in the second half of the year into 2014?
Well, Ruben, it's kind of funny because really in the 80s and 90s, the U.S. was the leader. They would lead into a recession. They would lead out of a recession. And, you know, there's a lot of talk over the last couple of years about a decoupling. But really, in this particular recovery, once again, I think the U.S. is back in the lead sled dog, basically. And what we're going to do, we're improving slowly. I think that is going to drag along the global market, particularly these emerging markets, over the course of the next 6 or 9 months, something like that. So I think once again we're in the leadership role, and when good things happen to our economy, you're going to see that reverberate through the rest of the globe.
So in terms of portfolio positions, where should investors be? Should they be focusing on the U.S. or should they be putting some of their eggs in the European or the Asian baskets as well?
I think right now large cap U.S. stocks are really the place to be. It's been the place to be. I think it's going to continue like that for a while. So in terms of sectors, I think you want to be in those sectors that are more sensitive to the ebb and flow of the global economy. The consumer discretionary sector, materials, technology, industrials are starting to look better. You know, and those sectors had a poor period of negative performance in the first quarter of this year, but have come on over the last 6 or 8 weeks. So I think that's where you want to be. You do not want to be, in my opinion, overweight healthcare, staples, utilities, places where people hide when they're afraid. And I just don't think that's going to be the case as we look out over the next 12 to 18 months.
Scott, thank you so much for joining us.
Thanks, Ruben.
We've been speaking with Scott Wren, Senior Equity Strategist at Wells Fargo Advisors. In New York, I'm Ruben Ramirez for The Street.